Take a look at this chart, which really looks at the fully priced in nature of what traders are expecting from the next 3 Fed meetings, 50 basis points priced in for each of those meetings. At the same time, we see this kind of tandem falling when it comes to equities as well as bonds. So where do you find opportunity at the moment? Is there still no better trade than selective equities?
I think so. I think if you look at the historical rising rate environment, albeit this time round, as Chair Powell mentioned yesterday, we are currently having express service when it comes to raising interest rates, at least for the next few meetings. I think in the longer run, over the next 6 to 12 months, we still think that the equity performance should continue to impress. I think for a couple of reasons. First of all, it comes back to the point that the Fed is going to be raising rates at the time of economic growth and strong labor market. So from that perspective, even though U.S. consumers are facing higher fuel prices and higher food costs, they should be able to withstand this reasonably well, considering the rise in wages as well as higher savings rates over the past couple of years. I think the second point is that the duration risks in fixed income continues to be a challenge. And if you look at, for example, corporate credit spreads in investment grade or high yields, they are relatively rich in terms of valuation. So I think the room for capital gain in fixed income is somewhat limited. On the other hand, in equities, you can either opt for the value rotation, in a rising rate environment, or you can opt for the high income, high dividend play, which could potentially also benefit from capital gain as well. So I do think there are more tricks in the equities world to deliver return to investors compared with fixed income, at least for the time being.
The 10% slump in the yen against the dollar this year should historically benefit exporters. Is that a good enough reason to look into Japan as we start to see some of that rotational buying into Japanese tech?
I think so. I think Japanese equities have always been somewhat underestimated by investors in APAC as well as around the world, albeit that we've yet to see the corresponding pickup in Japanese equities in response to the weaker yen, even at just a local currency value in terms of earnings growth. Japanese companies are still expanding their earnings quite decently, and valuations by no means expensive in Japan. So I do think that Japan deserves to be part of the asset allocation when it comes to equities. However, I think the concerns of potential capital outflow, further weakness in the yen because of the spread between U.S. Treasuries and JGBs, as well as the potential deterioration in the current account in Japan because of high energy import costs, all of that could potentially deter investors, at least for the near term. But nonetheless, I do think that Japanese equities will look a lot more interesting once you've found some stability in the yen, as well as combining that with the undemanding valuations when it comes to Japanese equities.
Similar question to that of Heidi's for the Chinese equity markets. This chart on the Bloomberg showing you how we're really not doing well, nearly back to levels before Beijing intervened around mid-March. And you have a weak Chinese yuan as well. Does that have any implications for Chinese equities?
Again, I think in the near term, investors are going to take a more cautious tone when it comes to China. But I do think a couple of potential catalysts could be on the way, one of which is, maybe perhaps towards the end of April or in May, once the pandemic comes under better control, there will be expectation that you could see a stronger rebound in the economy late in the second half. And at the same time, I think the government could potentially, again, unleash more stimulus to the economy, all of which could potentially lead to a more positive reaction in the market. So, yes, I think it's going to be tougher times for the Chinese equity market in the near term. But over the next 3 months or so, I do expect the Chinese equity market to also make a comeback, really on the back of the economy finding a bottom. There are some other uncertainties, such as regulations, such as ADR. On the ADR side, we have seen the Chinese regulators working with U.S. regulators in trying to resolve some of the delisting risks. But at the same time, the question is, whether the U.S. regulators will be satisfied with the concessions made by the Chinese authorities. I think that's going to be an important point to watch. For the regulations, we are moving from setting up the framework in terms of regulations, especially on the tech sector, internet platforms of last year to this year, which is enforcement. So I think for specific companies, they could still face some headwinds when it comes to new rules being applied to them. But at the same time, we are seeing these companies cutting costs and trying to protect their earnings.
how important will be the role of income in allocations across Asia, especially with central banks potentially raising rates faster?
Well, I think Asian central banks, you've seen Taiwan, you've seen South Korea, you've seen New Zealand raising rates, but I think they will be raising rates at a more gradual pace compared with the Fed. So, cash return across Asia is still going to be pretty low. And I think that will continue to fuel the demand for income investment or income themed investment. And as I mentioned earlier, fixed income, it does provide some degree of value when it comes to income generation, but we have seen more investors looking into high dividend equities, as well as some of the alternative assets, such as real estates, real assets, in order to generate that income, whether it's for retirement or just to provide a little bit more stability when it comes to portfolio return, as stock prices and asset prices are going through more volatility.